Good afternoon. This is Konrad Karwowski of Excalibur Financial Services with your weekly market update. Most of the data we will be providing is courtesy of our partner, JP Morgan Asset Management. First, we'll move to the overall slide, which we'll be looking at sections of, but this is the update for Monday, August 8th, but it really recaps the week ended Friday, August the 5th of 2016. In the equity and fixed income markets, the S&P 500, which is the largest 500 publicly traded companies in the United States, was up about 0.5%, and year to date, that index is up over 8%. Now, focusing on an area that we have overweighted in our portfolios for the clients that are reviewed with us, the Russell 1000 value was up just slightly, about 1/3 of a percentage point last week, but year to date is 9.78%, working in our accounts quite well. International, which we've kept a significant weight to, was unfortunately down last week about 1.1/3%, and year to date is down about 0.5%. So close to flat, but nevertheless still some more problems in Europe and European markets. Emerging markets, which is the second area that we really overweighted in our portfolios for 2016, experienced a good week, up about 1.44%, and year to date has really outperformed all other areas of the equity markets, up 13.64%. Moving on to fixed income, which are bonds. Last week we saw most of the bond market down just a little bit. U.S. aggregate, U.S. corporates, and municipals all down a little bit, but still positive year to date, anywhere between 4% and 8%, depending on which of those three sectors you're looking at. High yield, which is the third area that we overweighted in our portfolios, and really the third overriding theme in our recommendations to clients, was up last week just 1/3 of a percentage point, but year to date has a return of 12.4% and continues to have a pretty good yield at 6.99 or 7%. Now, moving on to a slide that shows the sector returns of the S&P 500. Again, the largest 500 stocks that are publicly traded in the United States. As you can see, utilities and telecom had a bit of a tough week last week, but the bottom bar chart shows that every sector of the S&P 500 is positive year to date. We crossed that threshold last week, and it's actually, financials have improved. So it looks like all sectors of the S&P 500 are on solid footing. We are into earnings season, and 80-something% of the companies of the S&P 500 are reported. The general reports have been good, some a little bit below expectations, but overall we're seeing fairly positive reports. On the next slide, I wanted to include this one, and it's really just, again, a part of the initial page that I show, is the price to earnings ratio of the various indices. And because I kind of cut it out, I wanted to indicate which one was for the S&P 500. And the price to earnings for the S&P 500 is 17.11. And there is a lot of sentiment out there in the media that the market is overvalued. And just to put things into perspective, the price to earnings ratio, in other words, how many dollars do you have to pay for each dollar of earnings per year of a company, has been 16.7. So 17 and change is certainly higher than that, but not dramatically higher. The next slide is just an interesting chart, and that is the amount of publicly listed companies. In other words, companies that trade on the stock market in the United States, or they're U.S. companies that trade in the stock market more specifically. Back at the end of December of '96, there were over 8,000 companies. Now there is about half that. As of June of 16, 4,333, and there could be several reasons for that. There's been merger activity. A lot of times companies that are no longer able to grow earnings organically will buy a company as a lower price to earnings ratio, which actually does create earnings growth, at least technically. But the other thing is that the cost of an initial public offering is quite high, and how much they have to pay to the investment bank to go public. And combine that with low borrowing costs, in other words, interest rates are at all-time lows. If you can borrow money at a low rate rather than taking the company public and selling off a large portion of it and paying high fees to investment bankers, perhaps it's better to just borrow the money. And that may be one of the reasons that we don't see as many IPOs and we have less companies that are publicly traded here in the United States. Going on to economic data, in the last week, we saw the manufacturing index did fall very slightly to 52.6. Jobless claims are up a little bit to 269,000, but the unemployment rate did stay flat, just under 5%. Many economists will tell you that 5% or so is considered full employment because there's always going to be some slack of those changing jobs or unable to work, etc. And non-farm payrolls are up about 255,000. Now, in the week ahead, we have some more job-related data. JOLTS, which is job openings and labor turnover, and we'll have that report this week, and also new jobless claims. And on top of that, we'll have retail sales, which will show us a little bit of what consumer sentiment looks like. Thank you for viewing this review of the markets from last week and the overall economy. If you have any questions, please contact us at 904-619-5944 or our website, excaliburfs.com. If you are in need of a portfolio review, portfolio management, financial planning, or any help in the financial service area, please don't hesitate to contact us. This has been Konrad Karwowski, CFP. Thank you for your time.